Good morning. Good morning to any replayers. Hello. Hope you're doing well this morning. You can still participate if you're a replayer. You can tap on the screen for hearts. You can share. You can, of course, find me on Twitter. Hi, Anthony. Find me on Twitter or Snapchat or YouTube. So Twitter is where I share my links. Snapchat is where you can find me and ask questions about your personal finance situation. And of course, you can also see my old Periscopes on YouTube. Good morning. I do, if I say so myself, I like my old Periscopes. So you can too. What's nice about YouTube is you can search because it's a Google property, so it's probably more searchable. Like if you're like, oh yeah, I finally wanted to set up my Mint account. I wonder like if there's any help because I have probably like 20 Mint Periscopes at least. And of course, other topics as well. And so as you know, I'm changing my format a little bit to just focus on a little bit of technical aspects of money. And on Tuesdays, I'm talking about taxes. And you may say, you know what, it's the last thing I want to do on a Tuesday morning, so you can save this broadcast and get back to it later. Why do I talk about taxes? So if you're new to me, by the way, let me introduce myself. If you're new to me, my name is Joanna Zarek. I do a daily money habits broadcast, but I'm changing it up a little bit because I feel like I've talked money habits to death and I won't stop talking about it, but I gotta keep myself interested. So I'm focusing on taxes because it's the second most important pillar of wealth building. It's actually more important than investing. It's more important than investing. Yeah, you know, I can't stop talking about money, but I'm focusing on taxes because I think that even though I say it, I want people to get more practical information and knowledge about the US tax code. And I'm breaking down the 1040, and that's how I'm following through for a couple of reasons. I think they're just tax concepts that I think should be simplified, but people get afraid of. And so today I want to talk about a specific section of the tax form, and it's the, by the way, if you want to follow along, you can always pull up 1040 IRS, pull it up and be like, okay, I can't see it on Joanna's phone, but I can see it on the screen. So why is this section important? So I'm going to flip back to it. I'm going to see how I do with this prop. So this is the section I'm talking about. So in the 1040, which is the full form, the adjusted gross income, and this is the 2015, so you know what, it can change from year to year. Yeah, get your copy out and follow along, right? So adjusted gross income, those are lines 23 to 37, and 37 actually just being 36 and 37 just being addition and subtraction lines. And I want to talk a little bit about each point. And say, again, why are these important? So why should you even care about the adjusted gross income section? Well, one is it's a place where your tax liability can go down, right? We talked about how you want to fill up your income section and say, if I'm only putting in one place, like a number in one place, if my W-2 is the only source, that's, by the way, under someone else's control, it'll lower your taxes. But it does two things. Most people think of tax deductible and things where are like claim tax deductible. Most things people think about when they think tax deductible are below the line. And we'll talk about below the line next week. But right now I want to talk about above the line and why that's important. It's two reasons. One is you may not have enough deductions to qualify for, like, to overcome the standard. I am not your dad, but you know what? I probably sound like him. Boy, you better get your taxes done. So you need to, you may not have enough deductions. So people get kind of enamored by, oh, that's deductible. And it's like, it may be deductible, but may not be deductible for you. I think even people who are used to having itemized deductions over time, as you age out, as your income goes down, Social Security and everything, maybe you paid off your mortgage, all of a sudden you do the calculation. This happened to my parents last year, by the way. My parents have been doing the itemized deductions for years, and last year their standard deduction was higher than all the itemized, than all of the itemized stuff they added together. So you know what, the donation, the charitable donation, and it's not to say you shouldn't make a charitable donation, but it's not part of your tax equation anymore. The above the line stuff isn't subject to being within the standard or itemized deductions. Those are all separate points. This is why it's important, because when you go through those, you go, okay, do I qualify for that? Because you want to. You want to take advantage of those. Children or adult medical expenses lower or higher. Yeah, those are like, those things can definitely impact that. But let's go through line by line and tell you, and I'm not going to be expert on each one of these lines, and I'll tell you why. So the tax code is written in, and then there are things that incentivize behavior. So if you look at number 23, that's educator expenses. So I have never been an educator. That's actually someone who's employed by a school. But what's interesting that this only came in the tax code not so long ago. But what it basically does, it incentivizes teachers to spend their own money and get a tax deduction for it. Isn't this interesting? So if you're a teacher or an educator of some kind, right, if you get paid, if you're a W-2 employee that has some teaching responsibility, here it is. This is no longer on the Schedule A on the miscellaneous expenses. If you can qualify as an educator and you've had expenses, this is where you want to deduct them. Number 23. You do not want to put them in the miscellaneous expenses that have to go above the 2% threshold. This is where you would put them. So that's one place. And you say, okay, you know, if you're in that line of work or you're anticipating being in that line of work, this is where you would have to listen for that. Number 24. Again, I've never had number 24. So you know what? One of the things that I need to do as I'm talking to you about these very important points, I realize that I may not know about some of these, so I'm going to look for examples, whether it's someone I meet in my line of work or just Google it to see what kind of expenses go in and how much are they, right? Certain business expenses of reservists. I'm like, that's a military person, I think. Performing artists. Okay, that's interesting. And fee basis government officials. Okay, first of all, I actually don't know what jobs fall into it. So I would have to look that up. So those are one of the things. If you think you qualify as one of those people, you need to look it up. But we're going to keep moving along. 25, health savings account deduction. I gotta talk about this because health savings account deduction is a favorite of mine. Here's the healthcare system is fraught. Pardon my ESL. It has a lot of tax implications. And one of the things people may not understand is the behavior of employers is often driven by the tax code. And so the fact that you get benefits and part of it is health insurance, the reason the reason that's a benefit is because it's cheaper for your employer to give you health benefits than give you that raise. Because you could just go out in the marketplace if someone give you extra 15 grand and buy healthcare. But because it's a favored, it was a tax favored expense that lowered costs for an employer, employers started offering it. And thus the healthcare marketplace, not the Obamacare marketplace, we're talking insurance company, payer, provider, all that thing was created because the tax code kind of drove some of the behavior. Story for another day, but the health savings account deduction. Here is why it matters. Every fall, you're going to go through, if you're an employee or if you are self-employed, you have to go through a selection process for your insurance. And you may have an option to take a high deductible plan with a health savings account. If you're following my advice and you're cash flow positive, you've got your savings, I will tell you 100%, take the plan with a health savings account. Take it. Control your cash. Understand that you may need to pay a higher deductible. And by the way, here is my point on higher deductibles. You will learn about the cost of healthcare when you have to write some checks. Now, most people pick the cheapest plan for cash flow. So they'll pick the plan that they think covers what they need, but costs the least for them, right? Like employers are shifting more costs onto employees. You really need to take a comprehensive look at how much cost this plan has. And if it's a high deductible plan, you qualify for the health savings account. Qualifying for a health savings account should be a goal. It is an amazing tax protected account. Health savings account rock. You can fund them every year up to a limit. You get a deduction on your taxes. By the way, if you're in a 28% tax bracket, that's a 28% return. You cannot get that in the market. So instantly you put aside money into an account, you get a tax deduction, and that money, you can, I'm not that clever. I have only had the health savings account like 2 or 3 years, so I didn't build it up. But think about it. If you were able to put $5,000 every year into a health savings account, you would be self-insured after a while. And I think you can invest them. I think they can be investable assets, and they're tax-free. So that's my point about the health savings account deduction. If you're evaluating it and you're scratching your head and you're wondering, I'm telling you right now, if you have the option of having a health savings account and you have cash flow under control, excess savings, and all that, take it. Take it and suffer through the deductible, because it's well worth it. Okay. Number 26, you carry over. Yeah, so health savings account, this is different than flexible spending account. Flexible spending account, a lot of people hesitate to put money in it because it's use it or lose it, right? But the health savings account, it's your money. So an FSA is totally controlled by another entity, by a benefit administrator. And the health savings account has a trustee, which means someone holds it, and they charge fees that are unreasonable, like I think $5 a month is unreasonable for just holding your money. And so you may not have a choice if it's through your employer, but when you separate from your employer, I believe you can change your provider for who has health savings account. So you keep that money. That is your money, and it's tax-free as long as you use it for health-related expenditures. Health-related expenditures. And it's not as strict as the FSA, because the FSA has to be administered by a benefits administrator, and your HSA, your health savings account, is not. So they actually make it a little bit harder to take money out. But by the way, you can reimburse yourself for expenses you incur, or you can have a card which you use to directly pay your doctor with that card. So no, it's not. It's the flexible spending account and health savings account, and I'm gonna add one more, the health reimbursement account, which is an employer sponsored and employer funded, are 3 different entities. And the HSA behaves very differently than the FSA. And the HSA is 100% advantageous. And if you have a chance, next time you're doing, and we're gonna have to review this in the fall, when it's benefits season, I'm gonna go hard so people take advantage of this tax favored account. It is amazing, and you keep it forever. It is yours. It is yours, and for your family. It's family expenses. It's a very loosely like, it's like 529 plans where you're like, how do they work? So know the rules, but this is a huge advantage. Okay, number 26 is moving expenses. Moving expenses. It's like actually the rules for if your moving expenses are deductible are fairly simple. It is all of if you're gonna move for work, and if you're a spouse, if you have partnership, for that. If you're moving for work within, I think, 6 months, and it's more than 50 miles away. So that's the basic test. So if you're gonna move, and see, here's the thing, moving, what happens to the savings? So you could withdraw the savings. I think there is a penalty, but like, you're gonna use it. You know how expensive Medicare? Like, people who are on Medicare think like that you're gonna use it, like, because you're gonna be in some health, what is it? The 90% of your healthcare costs in your lifetime come in the last 10 days of your life. This is unfortunate but true. It's the statistics. 90% of your healthcare costs that you and I will incur will most likely come in the last 10 days of our lives. So you're, like when someone gets that bill, they can pay for it with that account. But it's use it or lose it, or is a penalty. So you can take it out and pay the penalty, and it's worth the penalty because you've been accumulating that money tax-free for a long time. So don't worry about it. I always feel like, you're like, oh, what if I don't use it? I'm like, then you've lived a very good life where you didn't have to incur healthcare costs. I am jealous. That's not possible for me. I don't have a lot of health problems, but as I'm getting older, there's like health procedures. Actually, I had like some dental surgery yesterday. Talked to a young kid at the bank. He goes, I've never heard of it. I'm like, I know, because you're 20. I'm 40. I have to have repairs. So if you never use your HSA money, I'll bow down to you and ask you for health advice, because that's magic. You will use it. You will use it. You know, pay for the gas that you use to drive to the hospital, or parking things and stuff like that. Anyway, moving expenses, 50 miles, and get a job. Before you move, you should make a little file for yourself where you save all the receipts for every single thing incurred in moving, because you should look at the form before you move. And then, like, every time you stop for a snack or pay tips or anything like that, you should keep track of it. It's worth it. Number 27, deductible part of self-employment tax. Okay, that number 27, I never have to do anything, because in TurboTax, it's automatically pulled from your Schedule Cs, whatever Schedule Cs you may have. And you can have multiple, by the way. It's not a single Schedule C. Every business has a schedule. It will calculate a deduction for your self-employment tax. So when you are self-employed, when you're an employee and you have payroll tax in your paycheck, you pay half and your employer pays half. You never see that, right? You don't realize that you're actually more expensive to your employer than just your wages. So the government takes some from you, and they take some from your employer. Now, when you're self-employed, the government says you're both. So you're now paying 2 shares of payroll taxes, which, by the way, is like approximately 15%. Don't quote me on it because I don't have the number in front of me. 15% is payroll tax. So the government says, okay, that's not fair. We're going to give you a deduction above the line. So it's a deduction for self-employment tax. That's why there's like a 93 points. There's like a percentage that's calculated of how much self-employment tax you owe. I always overestimate because I don't like nasty surprises in terms of how much I owe. But that's going to come, something that's going to come out from your Schedule C. And again, if you use any program, that's a programmable thing, so you don't have to worry about it. But that's what's going to happen. It's going to be a self-employment tax deduction. So it's tax that you pay. Next one's my favorite. Okay. So what I don't like about the next line, number 28, it says self-employed, SEP, simple, and qualified plans. And I find that line encouraging and include an individual 401k. So those are basically retirement plans that you as a self-employed person have for yourself, or a small business. And as you know, if you're going to be self-employed, one of the main purposes for that, at least for me, is to be able to take advantage of the tax code when it comes to retirement account funding. That's the deduction. That's the deduction for taking, that's above the line, by the way, for funding your own retirement. That is a line I want to see on your tax return, and it needs to be filled. And if you ask me, and I've covered this before for self-employed people, if you're a solopreneur, which means if you're a single individual business owner and you do not have employees, because I know there's some funky rules once you start getting employees, or if you're a partnership with your spouse, you qualify for an individual 401k. The individual 401k is one of the best retirement vehicles known to men. Why? For everybody that goes, oh, fees, taxes, blah, 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 future tax, you can do a Roth 401k contribution to your employee portion, and it's not subject to income limitations. I know that's a mouthful, but I'll repeat again. If you're a solopreneur, you make a profit, you can take some of that profit, and not even the profit, you can contribute as an employee of yourself. Hi, how are you? You can contribute as an employee of yourself to a Roth 401k, which means you don't get a tax deduction on that, right? So you only get a tax deduction now, you only get a tax favor now or later. And again, if you're cash flow challenged, take the deduction now. But if you're already at that advanced stage, I want you to think long and hard about a Roth 401k. Telling you, it's well worth it. But this is where it would go. And everyone who's self-employed in some aspect or another, it could be a side hustle. Phone rings. If you're self-employed, you need to aspire and plan to have that line filled up. So if you're doing contributions, that's where you're going to contribute. So that's line 20. So again, if you are self-employed and you do not have anything in line 28, we need to talk, or you need to reconfigure your business to be more profitable to bring that money in. 9, self-employed health insurance deduction. Remember I talked about health insurance and the tax deductions and how employers started offering as a benefit? Well, this wasn't around for long, but this is where you take your health insurance deduction. You don't take it in the expenses section of your Schedule C. You can actually put your health insurance deduction above the line. Why is this important? We'll get to why all of this above the line stuff matters very quickly in line 37. But that's where you would put if you pay for your own health insurance, it is all tax deductible. It lowers your tax liability. So it's like getting, again, depending on your marginal tax rate, you're getting a discount. And you're putting yourself in a lower AGI bracket, which matters. Penalty on early withdrawal savings, never used it. So there's some sort of penalty, but the IRS doesn't charge you if you have a penalty. And I don't know. I haven't reviewed it. I've never had one of those penalties. Alimony paid, again, if you paying alimony to someone, they have to claim it on their tax return, you get to deduct it. So if you have that, if you're in that situation, that's where you put it. Number 32, of course. Number 32 is an IRA deduction. So again, one of my favorites. If your IRA deductions are subject to income limitations. So only some people can take a deduction. And I've covered it and we'll cover it again, but you can look it up. It changes every year. It changes for your marital status, etc. But if you qualify, and if you're still cash flow challenged, you should take advantage of it. You should try to deduct an IRA on your taxes. Contribute pre-tax money. Next one is student loan deduction. Student loan interest deduction. Again, income limitations there. Used to take it, used to have student loans. So if you have student loans, just don't forget to, collect those forms when they come in. And then you get a deduction for your student loans. And the interest rates are really low. So it's usually not a lot, but remember, every dollar counts. Tuition and fees. So again, this is a deduction for if you're going to school. I haven't covered it in a long time because I haven't had much tuition. My kids are still young, but I want to review that. I'm almost like want to circle the areas when I want to review. No clue what domestic production activities deduction. I've never used it, so I don't. So hi, how are you? So for me, I know I want to review lines 23, 24. I want to check what line 30 refers to. Line 34 and line 35. And by the way, they all have forms except for the educator expenses. And so I can look up the form, and that's how I learn. So when I go through that and I go, does this apply to me? I just go and Google the form. And by the way, you know what's awesome? 20 years ago, you had to go to the library to get the main form or write away for it. And today it's all at your fingertips. You're like, oh, form 2106, Google, look at it, read it, right? This is really, really important, and this is really, really powerful because it's all available to you, right? And so, those are the things. So, hello, French gladiator. And so, what you're going to, you gotta realize what do you call? I don't know, but that's distractions. So all of these lines, think about if they apply to you. Again, if you're self-employed, there's the self-employment tax, the retirement plan, and your health insurance deductions. Non, je ne peux pas parler français. Un petit peu. So when all of this are said and done, and again, the self-employed tax, that's being calculated automatically. Where you have a lever is the retirement accounts, right? This is why I harp on it. The elective stuff is the retirement accounts and the health savings account. Those are elective contributions. Those are not things someone sends you a bill for. This is important. In wealth building, the things that are going to make the biggest difference to you are things no one's going to ask you to do. No one's going to come knocking on your individual business and say, did you open a 401k? Oh, wait, no one except for me. Oh, bien, merci. And so basically, I want to I'm coming knocking on your door, but no one's going to send the bill, right? Everything else you get a bill for. Contributions to your own future, you don't get a bill for. So again, health savings account, your own self-funded retirement plan, and IRA contribution are the three levers that I think people need to focus on more. The other stuff associated with education and things we'll look into. So always understand if you qualify, and this may change from year to year, if you qualify for any of those deductions. Why does it matter? So you add them all up, line 36, and line 37 is the adjusted gross income. Why does the adjusted gross income being the lowest possible matter? It's because most of the tax law, where there are limitations, are written around the AGI, right? Adjusted gross income, or AGI. A lot of yeah, you know what? I wish there was more translating. I don't. I'm not that fluent. Goodbye. And so the adjusted gross income, you want to drive that to as low of a level as possible. Why? Because exclusions to the tax code on the second page of the 1040, now see below the line, right? Above the line, and the line is the adjusted gross income. That's what above the line means. So all those deductions are granted to you above the line. Once you get to the adjusted gross income, all the deductions below, a lot of them are limited by that number, whether you qualify or not. They are going to be limited by the adjusted gross income. A lot of benefits, a lot of people use that number as determining which side of benefit you fall. Do you get a benefit or do you not? Because basically most of the benefits were written in so that people who are doing the right things or have expenditures get some tax relief, right? All the tax code is relief for an individual from the burden of taxation on the fruits of their labor that were spent in a specific manner. When you keep it all, you don't get tax deductions, right? But when you're keeping it all, you don't get any tax deduction. When you spend it on certain activities, the government says we like these activities or we support them, like childcare, like education, like retirement planning, and we're going to go through some of those next week. So that's it. That's my Periscope on above the line deductions, to really bring forth these line items that make a difference. And some of them you do have control, and you may not be able to use them in the near term, right? Like if you were full-time employed and you're welcome, and you don't have side businesses or anything like that, you can't take advantage. But when you're planning out and you're saying, what does my prosperous future look like? And if I have a business, how big of a business do I need to fund some of these? And put it in your plan. If you start including these things that say, I not only want to have a profitable business, but I want to have a profitable business that enables me to maximize my individual retirement plan, right? If you start thinking in that way, you're going to start changing the equation, because you're not going to be looking for a $100,000 business. You're going to start looking for a $200,000 business. That's how much profit you're going to make, not just revenue, right? And it changes the equation when you start incorporating these things and saying, wait a minute, if I contribute, if I use this money in this way, the money that I come in command of, then I get a tax advantage. And by the way, the government's contributing to my wealth because they're reducing your tax liability because you decided to allocate your own money to these accounts. So that's really the bottom line of the above line deductions. But yeah, next week, I'm super excited. I know, I really love talking about the tax code and explaining it. It's not just that I love talking about it, it's I love understanding it deeper and then being able to explain it, to explain the differences, right, in simple terms about money. And yeah, so we're gonna talk below the line, and then tomorrow we'll talk about investing, wealth building, perhaps the individual 401k. We'll go into a little bit more detail because I really think it's an underutilized and not even known. Like, people don't know about the individual 401k. And everybody knows about the 401k, but the people associated with employment, and once they're no longer employed by someone else who doesn't, by the way, offer it, or some employers don't offer it, right? And if you have a side hustle, you can take all that money and put it in individual 401k, right? Like, that's the point. So I think that's what I'm gonna do tomorrow. I've gotten inspired. Tomorrow, on Wealth Building Wednesday, we'll cover the individual 401k because it is one of the most powerful tax and investment vehicles, and we'll talk about what I mean by a vehicle for investing known to me. And it's still very recent in the tax code. And by the way, there's not a lot of money to be made by by the financial advisory in this area. So no one's pushing it. No one's selling it because it benefits you the most. That's how you know. You know how you know if it benefits you or me, just the individual who's running it? Because no one's selling it. So that's it. Stay tuned. Thank you guys so much. It's Kazakhstan. It's going to be on the individual 401k. So on Wednesdays, I'm doing like Wealth Building Wednesday. So it covers some aspect of investing, the ways in which people can build wealth that's accessible, right? Whether it's an IRA, whether it's stocks, right? Whether it's explaining some concept of investing. I feel like I'm trying to demystify the concept of investing. And so that's what I'm going to be doing on Wednesdays. And yeah, I think tomorrow, individual 401k. And we can cover 401ks and individual 401ks. They're related. They're just two different, they're like, two halves of the equation. It's like one's for people who are employed and one's for people who are self-employed. So thanks a lot, you guys. Appreciate it. Appreciate the hearts and the engagement. I hope you learned something. And by the way, this is on Twitter now. They're being saved automatically on Twitter. So anytime you want to be like, hey, let me get a refresher, let me just listen to someone yap about the above the line deductions. Here I am. We're gonna be circling back to this. I think I need to schedule something for the fall in benefit selection season, because the FSA and the HSA and all those things are grossly misunderstood, and people don't know how to use them, and they're really, really powerful vehicles. So that's it. Okay. I'll see you guys tomorrow at 10 a.m. Great. Yeah, listen to replay. And again, these are on Twitter now permanently. So yeah, we're gonna be hitting benefit season hard, where I'm probably gonna be feeling like I'm talking about the same thing over and over. But I think it's well worth it. I feel like we need to spread the message further on some of these things. But yeah, tomorrow, 401ks. Check you out. Bye.